This number looks like the better deal. Lower rate, lower payment. The bank will smile and tell you you're being smart. But here's what they won't say out loud. That lower rate has an expiration date, and when it expires, your payment doesn't just go up, it can detonate. By the end of this video, you'll understand exactly how an adjustable rate mortgage works, the precise moment it turns against you, and the one rare situation where it's actually the smart move. Because for almost everyone watching this, it isn't. Let's strip the jargon. An adjustable rate mortgage, an ARM, comes in two phases. Phase 1, the fixed period. This is the teaser. With a 5-1 ARM, your rate is locked for the first 5 years. With a 7-1, it's 7. That's the first number. Phase 2, the adjustable period. After the teaser ends, your rate resets, and then it keeps resetting. That second number tells you how often. A 5-1 resets once a year. A 5-6 resets every 6 months for the rest of the loan. Here's the part the brochure buries. Your new rate isn't random. It's built from two pieces, the index and the margin. The index is a market rate that floats up and down with the economy, completely outside your control. The margin is a fixed markup. The lender bolts on top, and it never goes away. So, when your teaser ends, the bank does simple math. Index plus margin equals your new rate. Today, that might land you around 6.5%, but the index can climb. And if it does, so does everything you owe. Right now, a 30-year fixed sits around 6.5%. An ARM might offer you 5.7. On a $400,000 loan, that lower rate saves you roughly $200 a month at the start. $200. That's the bait. And it's real. For a while. But ask yourself the question. The salesperson hopes you won't. What happens in year 6? Because the discount was never a gift. It was a loan against your future payment. The bank is betting that by the time the rate resets, you'll either be locked in, unable to refinance, or simply too busy to fight it. And most people are. When that fixed period ends, the caps decide your fate, and almost nobody reads the caps. Every ARM has 3 caps, and they look like this: 2, 1, 5. The first number, the initial cap, is how much your rate can jump the very first time it resets, 2%. The second, the periodic cap, is how much it can move at each reset after that, 1%. The third is the one that should scare you, the lifetime cap, 5%, above where you started. Let me show you what that actually means in dollars. $400,000 loan, ARM start rate 5.70%. Years 1 to 5 to 5.70% to approximately $2,322 per month. Year 6 to 7.70% to approximately $2,790 per month, plus $468. Year 7 to 8.70% to approximately $3,030 per month, plus $708. Lifetime cap 10.70% to approximately $3,555 per month, plus $1,233. Same loan, same house. But once the teaser dies, that cheap mortgage can cost you over $1,200 more every single month. That's nearly $15,000 a year, gone, with nothing to show for it. And here's the cruelty of the timing. Rates usually rise when the economy is shaky, exactly when your income is least secure, and refinancing is hardest. The ARM doesn't just raise your payment, it raises it at the worst possible moment. When you sit down to sign, you'll hear 3 reassurances. Each one is technically true, and dangerously incomplete. Lie number 1. You can just refinance before it adjusts. Maybe. If rates are lower then. If your credit is still strong. If you still have equity. If you still have the income. That's 4 ifs. and you don't control a single one of them. Lie number 2, there's a cap, so you're protected. A cap of 5% above your start rate isn't protection. It's a ceiling so high, it barely qualifies as one. A 5.7% loan can legally climb past 10. The cap protects the bank's reputation, not your wallet. Lie number 3, you'll probably move before it resets anyway. Probably. Studies say people plan to move and then don't. Jobs change, families grow, life happens. Betting your largest monthly expense on probably is not a strategy. Now, I promised you the one situation where an ARM is the smart move. I keep my promises. An ARM can work if you check every one of these boxes, not most, all. 1. You are certain, not hopeful. Certain. You'll sell or pay off the loan before the fixed period ends. 2. You have the cash to absorb the higher payment, even if you're wrong. And 3. The gap between the ARM and the fixed rate is large enough to be worth the risk. That's it. A short-term owner with reserves getting a meaningful discount. A doctor on a 3-year contract. An investor flipping a property. People who can take the bet because they can afford to lose it. If that's not you, and for most home buyers, it isn't, the ARM isn't a deal. It's a wager with your housing on the line. So, here's the honest play for almost everyone. Take the fixed rate. Yes, it's higher today. But you're not buying a low number. You're buying certainty. Your payment in year 10 is the same as year 1. No resets, no caps, no countdown. If rates fall later, you refinance down, by choice, on your terms. With an ARM, the rate moves whether you like it or not. A mortgage shouldn't be a source of anxiety every 6 months. It should be the one bill you never have to think about. If this saved you from a 5-figure mistake, subscribe. And tell me in the comments, were you ever pitched an ARM? Did you take it? I read everyone.